Fiscal policy errors around the world have built a $100 trillion ticking time bomb, and it is only a matter of time before something starts to break. We can see debt loads compared to the GDP of their respective countries are set to explode into the coming future. And this comes directly from the IMF themselves. Keep in mind, these projections always include perfect tax projections, meaning no loss in tax revenue, no recessions expected, which would bring a loss in tax revenue, and it also anticipates nothing else breaking. No wars, no unexpected expenses, and probably most importantly, it anticipates interest rates staying where they're at or sometimes even moving lower. And given the inflationary monetary policy we've had around the world and will probably have for the foreseeable future, it is unreasonable to expect that interest rates won't move higher. These projections are across the board. If we take a look first here at Italy, we can see the very apparent spike in debt to GDP from COVID, the drop back down, and the anticipated growth from here. Quick note on those spikes and then drops. Those are a result of first the borrowing happens, so immediately the debt to GDP spikes, then the spending happens, which artificially pushes the GDP higher. And so as the GDP then rises as a result of the spending from the debt to GDP ratio temporarily corrects, but then you still have the debt to GDP ratio get much worse after that. That's what we're seeing here in these charts. With the debt to GDP ratio going to 156% by 2050, in the UK going to 136% by 2050, in Japan going to 329% by 2050, and Germany, the outlier in the bunch, projected to drop to a healthy 42% by 2050, but China expected to reach 115% by 2050, and the US expected to reach a staggering 197% by 2050. Now, if you pay attention to these numbers at all, there should be a red flag there because you should be looking at that 197% thinking, that seems a little low. Now, it is true, the actual debt to GDP ratio of the United States right now is above 120%. The last time the US had a debt to GDP ratio this bad was World War II. And this time we don't have a war that we can just stop spending all the money on, bring the troops home, and let our economy boom. We have governmental expenses that are mandatory by law and political suicide to try and do anything about, like Social Security, Medicare, healthcare, education, and of course, military spending. None of those expenses are going away anytime soon, regardless of who's in office next. So the real debt to GDP ratio is over 120%. So why is it that people like Janet Yellen and the IMF are talking about a 95% debt to GDP ratio for the US? Well, it comes down to this chart right here. When you split apart the US government's debt into three categories, we have the real national debt number, which is around $36 trillion right now. And we have about 28.5 trillion of that is what the government owes to the public, meaning banks, institutions, individuals, organizations, foreign central banks, other countries, basically the money it owes to everybody else. And then we have this category, about $7.5 trillion that the government owes to itself. This is called intragovernmental holdings of treasuries, which means that because the government owes that money to itself, many people decide to just erase that from the calculation. One example of this would be the treasuries that are held inside the Social Security Fund. Right now, when you pay your taxes, you see the amount that goes to federal income tax, state income tax, and the part that goes to the Social Security Fund. You're paying into a big bucket, and then from that bucket, it pays out all the people who are currently collecting Social Security. But while that cash is in there, it sits in the Social Security Fund, but it doesn't just sit as cash. It is loaned back to the US government for regular expenses, for all the other things that the government spends money on. And in return, the Social Security Fund gets an IOU called a treasury. Now, it may be that the interest expense on this portion of the debt can be considered a wash, but it is certainly not the case that you can just discount all intragovernmental debt, because those still represent liabilities. At the end of the day, it's still money that the government has to pay out when that debt matures. It'll have to roll that debt over, and especially in the case of the Social Security Fund, which is going to be drained by probably 2032, all of that money is going to be paid out. It is an IOU, which means it's a liability that has to get paid at some point, and it will be. Further than that, some people even like to add on the obligations of the United States government for the future. Like, what happens when the Social Security Fund runs out? The government's going to have to make up that shortfall. That is a larger expense that they're going to be paying in the future that is kind of like like debt, even though it's not listed. We know exactly how much it's going to be, but it just doesn't show up on the books yet. So the IMF, Janet Yellen, and other economists like to say the US has a 97% debt to GDP ratio right now because some of its debt it owes to other parts of its own government. But since those still represent actual liabilities that have to be paid, the real debt to GDP ratio is over 120%. And if you take a look at this terrifying chart created by the House Budget Committee, you can see that the Congressional Budget Office estimates within 30 years, the United States will have $120 trillion in unfunded liabilities. Now, I've focused here mostly on the United States because that's where most of us live, but this problem is far from isolated to the United States. And in fact, the United States has the added bonus of the rest of the world using dollars. And the reason why that's a bonus for the United States is because we happen to control the quantity of dollars, which means that the cost of our problem is at least somewhat borne by the rest of the world. Now, it's clear that there is no way to actually pay this debt back. There's no way to actually pay for all of these liabilities. So there are only a few ways this can possibly play out. Number one, somebody decides to just not spend that money. They say, no, we're not going to spend it on this. We're not going to spend it on that. We're only going to spend what we can take in taxes. And given the fact that this is so unlikely, it is almost certainly not going to happen. We don't even need to spend any time talking about the ramifications of it. Option number two is default as a result of political stalemate. It is possible that we have conflict politically that doesn't allow a resolution or a spending plan moving forward, which means that by default, they default. But that is also pretty unlikely, seeing as how this would probably be political suicide for all of the lack of decisions that were made, resulting in the default and potentially a short-term recession, depression, and lost jobs. Currently, the entire US money supply is only $21 trillion, which is substantially less than just the amount of debt that the US government owes back at $36 trillion. That's why the most likely outcome here is printing, because without printing and inflating the debt away, there is no option except for defaulting. And so the most likely outcome here is printing enough money to cover the expenses, including covering rolling over and expanding the debt. Now, this will certainly drive up prices of assets and goods and services for the foreseeable future as measured in dollars. But this doesn't mean we are going to have hyperinflation in dollars. It also doesn't mean that the rest of the world will be dumping dollars. In fact, it almost certainly means that demand for the US dollar around the world will continue and may even grow. How in the world could that be possible? Well, it's because there is over $100 trillion globally in US dollar denominated debt. I need to be very clear here. I'm not talking about countries or institutions who have loaned money to the US government. I'm talking about individuals and countries and institutions and organizations who have borrowed money denominated in dollars, which means they owe dollars back. Companies around the world have borrowed dollars and owe dollars back. Countries around the world, like China and Germany and Nigeria and Guatemala, have borrowed dollars, and not from the United States, just from other countries who have gotten those dollars the same way you and I get dollars, which is by selling services and asking for dollars as payment. And seeing as how every single dollar in existence has been lent into existence, that's how dollars are made. They're made through borrowing. It means that every dollar in existence around the world represents debt, which is demand for dollars. And that $100 trillion of dollar denominated debt around the world means that those individuals and institutions and countries need to sell things, maybe sometimes their own money, in order to get dollars to pay that debt back. This demand for dollars dwarfs currently what the United States is doing to increase the supply of those dollars. This means that for the foreseeable future, the United States will absolutely be able to continue to increase its debt to GDP ratio. It can print money to allow it to increase its debt, to pay for its deficits and all of its expenses, regardless of the size of its economy, because that overwhelming supply of new money hitting the economy gets exported around the world to other individuals and institutions and countries who desperately need to get their hands on dollars just to service their own dollar debt. This isn't a game that lasts forever, but it is certainly a game that lasts far longer than many of us wish it would. And finally, if you are watching this video on Monday, the day I release it, don't forget to go down into the link in the description below. Check out the election chaos trade. As always, thanks so much for watching. Have a great day.